All right, welcome back. This is Si Wing Yi from the Yi Real Estate Network. I have a very exciting and very significant information I would love to share with you. I'm going to predict the mortgage rates for the next 5 years, right? This is a very, very important topic. So with that in mind, let me share my screen and let's get us started and make sure to like and subscribe to my YouTube channel. And if you see value in this presentation. So mortgage rate prediction in the next 5 years, a Treasury yield-based framework for where the 30-year fixed rates are headed through 2030. Wow. And the source of this information is Deloitte, Goldman Sachs, and everything else. All right. Where economists see treasury yields. The 10-year treasury yield is very, very important. Okay. The mortgage rates track the 10-year US treasury yield, running consistently above it to compensate lenders for added risk. Mortgage forecasting mortgage rates starts with the forecasting the treasuries. All right. So Deloitte 10-year treasury forecast, right, from this year, 2026, okay, to 2027. So this year, 4.05, 2027, 3.95, 2028, 3.92, 2029, 3.92, and 2030, 3.92. Now, usually, whatever is the 10-year treasury, the actual mortgage rate is probably around anywhere from 2 to 3 uh, uh, rate higher, right? So on the average, if the 10-year treasury this year, for example, is 4.05, then the actual mortgage rate could be anywhere from 2.5 to 3 percentage point higher. So hence today's mortgage rate, according to the Mortgage News Daily, is around 6.75%. Okay. So that's, like 2.7 percentage point higher than the benchmark 10-year treasury yield. Does it make sense? All right, please comment below if you have any questions on the data I'm sharing with you throughout this presentation. So the other institutional forecast as on this particular study is Goldman Sachs. Goldman Sachs 10-year treasury rising to 4.5% by 2035. That's their long-term view. And the Congressional Budget Office, they have 4.1 by the end of 2026, gradually increase to 4.3 10-year treasury forecast by 2030. Okay, and then Claude AI synthesis consensus forecast blending Deloitte, Goldman, and CBO views. All right, the treasury mortgage spread. I already explained this to you, right? So the 30-year fixed rate sits above the 10-year treasury by a margin called the spread, right? Driven by prepayment risk, credit risk, and mortgage-backed security supply and demand. That spread spread widely sharply after 2022 and is now normalizing. Okay. So anyway, let me see what else I need to go on. So example, I kind of explained it to you, right, on a previous slide. If the 10-year treasury is 4%, if the spread is 2%, then the 30-year fixed rate is 6%. Make sense? All right, so let's go on. So the base case is a 5-year mortgage rate outlook. Okay. All right, so here's the mortgage rate scenario. 6.2 is a little bit low. Okay, right now it's like I said, around 6.7. So the next few years, here is the potential mortgage rate: 6.05, 5.85, 5.75, 5.70. That's the best case scenario. Okay, and here is the 10-year treasury rate, right? And there's a spread, the spread between this and it. That is called a spread, which is right here. Okay, so here it is. The spread from 2026 is 2.15. Okay. Hopefully by the end of this year, maybe. No one can predict the future, as we all know. No one have a crystal ball, but people do make predictions. Companies, uh, the rating services do make their appropriate predictions. So 2027, the spread is the Treasury is 4 point and the spread is 2.5, so 6.05. So, the best case situation is a couple of years from now, 2028, 2029, 2030, the mortgage rate going to hit below 6%. If anytime the mortgage rate hits below 5.55% handle. I mean, when you have a 6 percentage to come down to 5%, we see a psychological trigger, right? Wow. I mean, the delta, the psychological effect. So I feel that, remember at the beginning of the year, February, March of this year, 2026, when the mortgage rate fell all the way down to 5.99%, and everybody just got all excited, freaking out. Oh, finally, the mortgage rate is coming down to 5% handle. And then a few weeks later, March, April, May, then the mortgage rates start rising up pretty significantly, all the way up to 6.7 something percent as of today, as I'm speaking with you in August in 2026, because of course, because the war in Iran, that triggers everything, right? The worldwide economic uncertainty with the Iran war creating this issues. So the sooner the war the war is over, the world is back to a normal life, then the mortgage rate hopefully will gradually come down. We can only hope. All right. So let me see what else. The bull case and bear case, right? Bull market and the bear market. The bull case is we're gonna have a soft landing. The Fed guides inflation back to 2%, right? That's a benchmark. 2% is quite ambitious, but the inflation right now is way higher than 2% because, as you can see, the rising gas prices, the oil prices are elevated due to the Iran war, the whole 9 yards. So the Fed are not meeting their target of 2%. Okay. So without a hard recession, okay, they wanted 2%, the best case. So let me see what else. So yeah, that's the goal, right? I mean, 4 years, look, some people are gonna wait until they wanna, whether you're a home buyer or risk investors, the worst situation is to try to wait to buy until the mortgage rate come down below 5%. That is you cannot time the market, all right? You buy when the time is right for you, given your situation. So the mortgage rate 6.7%. Okay, I focus on risk investing. I keep telling my investors, if you get a good deal, if you buy the investment properties the right way, 6.7% is not bad. It's 6.7% or even slightly higher, 7.2%. If you can get cash flow on your rental property based on your underwriting, like 20 to 25% down payment, if you got a great deal, a discounted deal, you got some great buyers incentives or whatever, who's to say you shouldn't take action right now, right? And similarly with a primary homeowner, right? If your situation is such that you have to get a house, you have to move up to buy a bigger house, whatever your life goals are, don't don't let that uh, don't let the mortgage rate to affect you, right? You can't time the rate, you can't time the market. So, I mean, as long as you know your buy box, as long as you know your monthly payment, if you can afford it, of course, get a loan pre-approval, and just focus on your unique goals and objectives, what's right for you. All right. So don't time the market, don't time the rates, in the whole 9 yards. I keep telling people that, right? So the bear case, if you will, the the worst case scenario, if the inflation keep persisting, and inflation stick above 2.5, and it is a mounting fiscal deficit deficits push the term premium higher. If the 10-year go between 4.4 to 4.6, and if the spread widens to a 240, basis point, right? And the volatility and the mortgage-backed security supply weak on the markets, then the rates will climb towards 7% by 2027 before it eases to 6.6% mortgage rate by 2030. So the peak 30-year fix is give or take above 7%. We don't want another psychological barrier. I mean, the demand is not as great now because the mortgage rate has elevated to 6.7%, whatever today, right? But this is a six handle. If the psychologically speaking, right, the psychology of a home ownership goes the opposite way, right? Earlier, I said if the mortgage rate come down below 6% and becomes 5.99% or lower, that trigger a very, very energetic, positive effect, and people can come off the sidelines and start, get into real estate. Same thing, if the mortgage rate increased from 6.7 today to all the way to 7% or higher, the psychological adverse effect from this drastic change from mid 6% to 7% or higher, it'll trigger a very negative psychological effect. So it'll create it will lowers demand. If the demand is lower, then there will be less sales transactions. There will be less transaction, and people gonna stay on the sidelines, and so that's not good for the economy. Does that make sense? So the either direction, like I just said, is not good. So the margin of error. So these are long-term estimates built on historical norms and broad expectations, and any of the following could reshape the outlook, right? Treasury yield diverge, right? The spread shifts, and the Fed policy changes. So all these three scenarios can have an effect on how on the predictions as we for the next 4 to 5 years. So the key takeaway from this video presentation is: will rates ever hit 3% again? Not in any 5-year forecast. You need some sort of some sort of black swan, like another pandemic, which we do not want that to potentially hit a mortgage rate below 5%, below 4%, down to 3%. That is unrealistic. So if any of you out there, you know, or thinking about you're going to wait until the mortgage rate come down to 3% before you take action, well, you're going to be potentially waiting for a very, very, very long time. All right. Like I said, it will take a shock on the scale of the Great Recession or a pandemic, okay, to hit 3% again. What about 2027 specifically? Best case points to 30-year fixed rate near 6.05%, with Treasury 10-year yield around 4%. That's the best. That's the most realistic. Will rates drop meaningfully? Not significantly in the best case. A gradual glide from 6.25 to 5.70 by 2030, absent a recession or major disruption. Okay, so that's my takeaway. So what is your takeaway? What are your comments? Please comment below whether you believed our projection, 5-year projection by Goldman Sachs and by Deloitte are within or realistic or not. Comment below. So what it all depends, right? What are your goals, right? I mean, do you really want to wait until the rates come down? 6.7% from a historical basis, over a 50-year tracking is not that bad. It's pretty aligned to a historical rates, a mortgage rate. So, but then again, you don't feel that way, right? Because of skyrocketing home prices in the past few years since the pandemic, and the elevated mortgage rates have caused some tremendous home affordability issues, right? We all know that this is The news is everywhere. People can't afford to buy. It's too expensive. With inflation, with the high mortgage rate, with the high housing prices, with the median price of homes hitting in the or close to mid $400,000, a family or a couple or a single individual need at least $100,000 of a W-2 annual salary in order to afford a typical medium price of a home. So a lot of people are delaying home ownership because of the affordability factor. Although the wages are slowly creeping up or catching up with the home prices, because the home prices has been kind of stabilizing in the past 3 years, and wages has increased in line inflation. So the affordability factor has improved ever so slightly in the past few years, but still, a lot of people are still sitting on the sidelines, not only because they cannot afford to buy a home, but because of the economic uncertainty, artificial technology, the AI factor, the people are concerned about their jobs because of AI and technology, the worldwide economic uncertainty with the war, with the political chaos going on all over the world. But, I mean, you can't personally speaking, you can't let fear that could impact your definition of American dream. To me, if you're primary homeowner, hey, you're better to become a homeowner than a renter, right? And if you're a real estate investor, you buy the deal not based on the mortgage rate, based on the deal itself. Does it cash flow? Did you buy right? Did you buy good? Okay. Did you get all the buyer's incentive? Because right now is a buyer's market. So real estate investors is a different ball game. It's never wrong, no, wrong time to buy. You buy real estate and wait instead of wait to buy real estate. Right. So, that's the takeaway, right? The mortgage rate uh, potentially is better in the next few years. That's the prediction. It might come down below 60% in the next 4 years, but who knows? But don't wait forever. Take action based on your goals and your objectives to determine what's right for you in your own unique family situation and whatever. All right. So if you receive any value whatsoever from this presentation, from this video, please like and subscribe to my YouTube channel. Wing Yi, and also furthermore, you can put your email into my website, into my newsletter database, so that way you become a free member of our real estate investment network, the Yi Real Estate Network. We have several thousand members who are free, and you have access. We can a lot of great free contents coming to your email inbox on a weekly basis talk about real estate investment opportunities and real estate market and general educational content. So you become an informed real estate person. All right. Thank you so much. Have a nice day. I will see you next time. Bye bye.